Stop everything you are doing right now because what I am about to tell you is one of the most significant developments in the silver market in years, and the mainstream financial media is either ignoring it or completely misunderstanding what it means. Jane Street, one of the most sophisticated and secretive trading firms on Wall Street, just became the single largest holder of the iShares Silver ETF. They acquired 20.6 million shares in the fourth quarter alone. 20.6 million shares. That is not a trade, that is not a hedge, that is a statement. That is one of the smartest money managers on the planet making the biggest silver bet in the history of this ETF. And at the exact same moment this news breaks, warnings are circulating about potential financial engineering and market manipulation behind the recent surge in silver prices. So which is it? Is silver being manipulated higher by Wall Street insiders? Or is one of the most sophisticated trading operations in the world positioning for something massive that retail investors do not see coming? The answer is more nuanced than either extreme, and by the time you finish this video, you are going to understand exactly what Jane Street's position means, why the manipulation warnings might actually be telling you the opposite of what you think, what the mining production data reveals about physical supply, and why the combination of tariff escalations, Iran sanctions, and a weakening dollar creates the perfect environment for precious metals to continue higher. Before we dive into the analysis, I want to know where you are watching from. Drop a comment right now and tell me your country or your city. I see viewers from all over the world and I want to understand how global this audience really is. Whether you are watching from the United States, Canada, the United Kingdom, India, Germany, Australia, Singapore, South Africa, Japan, Brazil, the Philippines, wherever you are on this planet, type your location in the comments. I read every single response and it helps me create better content for this community. Also, if you have been watching these videos and getting value from them but you have not subscribed yet, take 1 second and hit that button. It costs you nothing and it helps the channel reach more people who need this information. All right, let us break down what is really happening here. Let me start with Jane Street because if you do not know who they are, you are missing a crucial piece of context. Jane Street is not a hedge fund in the traditional sense. They are a quantitative trading firm, one of the largest and most profitable in the world. They specialize in market making, arbitrage, and algorithmic trading. They trade billions of dollars every single day across every asset class you can imagine. Stocks, bonds, commodities, derivatives, crypto. If it trades, Jane Street is probably involved. What makes Jane Street different from most firms is their approach. They do not make bets based on gut feelings or analyst opinions. They use sophisticated mathematical models and data analysis to identify opportunities. They look for mispricings. They look for information edges. They look for situations where the market is not properly reflecting underlying value. And when they find those situations, they deploy capital at scale. So when Jane Street acquires 20.6 million shares of the iShares Silver ETF in a single quarter, that is not random. That is not a junior trader making a speculative bet. That is the result of their models identifying something in the silver market that justifies a massive position. They have looked at the data, they have run the numbers, they have analyzed the probabilities, and they have concluded that owning silver exposure at these levels makes mathematical sense. Now here's where it gets interesting. At the same time this position was revealed, warnings started circulating about potential financial engineering and market manipulation in silver. Some commentators are suggesting that the recent price surge was artificially created by institutional players, that the rally is not organic, that retail investors are being set up for a trap. Let me address this directly because I think the manipulation narrative is being misunderstood and potentially weaponized to shake retail investors out of their positions at exactly the wrong time. First, let us acknowledge reality. Yes, the silver market has been manipulated in the past. Major banks have paid billions of dollars in fines for spoofing, layering, and other manipulation practices in precious metals markets. This is documented fact. It is not conspiracy theory. It happened. The question is not whether manipulation exists. The question is what direction the manipulation is pushing prices and who benefits. Here's what I want you to consider. If large institutions wanted to accumulate silver at low prices, what would they do? Would they put out bullish reports encouraging everyone to buy, which would drive prices higher and make their accumulation more expensive? Or would they put out warnings about manipulation and financial engineering, scaring retail investors into selling, which would push prices lower and make accumulation cheaper? Think about that for a second. The manipulation warnings might themselves be a form of manipulation, not manipulation of the price directly, but manipulation of retail sentiment. If you convince retail investors that the rally is fake, that it is engineered, that it is about to collapse, what happens? Retail sells, price drops, and institutions with the capital and conviction to hold through the noise accumulate the shares that retail is dumping. I am not saying this is definitely what is happening. I am saying you need to think critically about who benefits from the narrative you are being told. When Jane Street is buying 20 million shares while warnings circulate telling you to be afraid, ask yourself whose interests are being served by your fear. Now let me give you some context on the price action, because silver just dipped below $90, and I know some of you are watching your screens nervously. May silver futures dropped 2% to $89.81. Spot silver is at $89.56. Gold futures pulled back slightly to $52.11. Spot gold is at $51.97. The dollar index is at 97.57. On the surface, this looks like a risk-off day. Precious metals are pulling back. But let me show you what is actually happening beneath the surface. The pullback coincides with markets being cautious ahead of the latest round of talks between the United States and Iran in Geneva. When geopolitical negotiations are imminent, traders often reduce exposure to wait for the outcome. That is not bearish, that is prudent risk management. Once the talks conclude, regardless of the outcome, clarity returns and positions get rebuilt. Meanwhile, the United States just imposed sanctions on more than 30 entities supporting Iranian oil and weapons sales. This is an escalation, not a de-escalation. More sanctions means more tension. More tension means more uncertainty. More uncertainty means more demand for safe haven assets. The pullback you are seeing is happening against a backdrop that is fundamentally supportive of precious metals. And here is the tariff situation. U.S. Trade Representative Jamieson Greer announced that Donald Trump would sign a directive to raise global tariffs to 15% where appropriate. This comes after the new 10% duties took effect this week. We are not seeing tariffs come down. We are seeing tariffs go up. And as tariffs increase, supply chains get disrupted, inflation pressures build, and investors seek protection in assets that cannot be tariffed. You cannot put a tariff on gold sitting in your vault. You cannot put a tariff on silver you already own. So when you see silver down 2% on a day when the fundamental backdrop just got more bullish, what are you actually seeing? You are seeing a shakeout. You are seeing leverage traders getting stopped out. You are seeing weak hands transferring their positions to strong hands. You are seeing the exact kind of volatility that precious metals have always exhibited and that separates long-term winners from short-term losers. Let me ask you a question, and I want you to answer honestly in the comments. When you saw silver drop below $90, what was your emotional reaction? Did you feel fear? Did you feel regret for not selling higher? Did you feel the urge to dump your position before it goes lower? Or did you feel calm, maybe even excited at the opportunity to add to your position at a better price? Your emotional reaction tells you how well positioned you are psychologically, because if you cannot handle a 2% pullback without wanting to sell, you are going to get shaken out before the big move that makes holding worthwhile. Now let me talk about the mining production news, because this tells you something important about the physical supply picture. Nikola Mining just announced they are ramping up production of high-grade gold and silver concentrate. They have transitioned their processing from gravity and flotation recovery to a flotation-only circuit to suit their new mill feed. They are optimizing their operations to enhance metallurgical recoveries, improve concentrate grades, and maximize payable metal content. Here is why this matters. When mining companies are investing in optimization and ramping up production, it tells you they are confident in the price environment. They would not be spending capital on upgrades if they expected prices to collapse. Their actions reveal their expectations, and their expectations are bullish. But here's the nuance that most people miss. Even when mining companies optimize and ramp up production, the increase in supply takes time to materialize and is typically modest relative to total global demand. Mining is a slow business. You do not flip a switch and double output. You make incremental improvements over months and years. Meanwhile, demand is growing faster than supply can respond. The CEO of Nikola stated that their integrated milling infrastructure provides operating leverage to strengthening precious and base metal markets. Read that carefully. Operating leverage to strengthening markets. The CEO is not hedging. He is not being neutral. He is explicitly positioning the company for a continued bull market in precious metals. These are people whose livelihoods depend on understanding the supply-demand picture, and they are acting bullish. Now let me connect all of these threads, because this is where the analysis gets powerful. We have Jane Street, one of the smartest trading firms in the world, making the largest silver ETF position in history. We have mining companies ramping up production and optimizing operations in anticipation of strengthening markets. We have the United States escalating sanctions on Iran and increasing tariffs on global trade. We have the dollar weakening. And we have silver pulling back slightly after a massive rally, creating what could be an opportunity to enter or add to positions. What picture does this paint? It paints a picture of a market that is fundamentally supported by multiple factors, experiencing normal volatility and being accumulated by sophisticated players, while retail investors are being warned to stay away. Let me ask you another question. If Jane Street is wrong, what happens? They lose money on their silver position. That is bad for them. But Jane Street manages risk meticulously. They do not make concentrated bets without conviction based on data. The fact that they are willing to be the largest holder of this ETF tells you they believe their edge is significant. Now, what if Jane Street is right? What if their models have identified that silver is undervalued relative to the fundamental supply-demand picture? What if the combination of industrial demand from solar and EVs, investment demand from monetary uncertainty, and supply constraints from years of underinvestment in mining creates a setup for dramatically higher prices? In that scenario, Jane Street makes a fortune. And retail investors who sold because they were afraid of manipulation warnings miss the move. I know which scenario I would rather be prepared for, but you have to make your own decision based on your own analysis and risk tolerance. Now let me talk about the technical picture because this gives us levels to watch. Silver futures dropped to $89.81. The key level that needs to hold is around $85. That is the support zone that has been tested multiple times. As long as silver holds above 85, the bullish structure remains intact. A close below 85 would suggest more downside is possible and would require reassessing the short-term outlook. On the upside, the resistance is at $92, which was the recent high. Above 92, the next targets are 95 and then the psychological $100 level. Given the fundamental backdrop, I expect these levels to be tested. The question is timing, not direction. Gold is holding above $5,000 despite the pullback. Spot gold at $51.97 remains in the structural repricing phase that analysts have identified. The 12-month targets from major institutions remain $6,000 and higher. The medium-term targets extend to $7,500. A pullback to $5,100 would be a normal correction within that larger trend. A break below $5,000 would require more serious attention. The dollar index at 97.57 continues to show weakness. A weaker dollar is supportive of precious metals because it makes them cheaper for foreign buyers and reflects underlying stress in the monetary system. If the dollar continues to weaken, that is a tailwind for gold and silver. Now I want to address something that I think is causing confusion for a lot of people: the relationship between paper and physical markets. Jane Street bought 20 million shares of the SLV ETF. That is a paper claim on silver. It is not physical metal in their vault, so does their purchase actually affect the physical market? The answer is yes, indirectly. When shares of a physical silver ETF are purchased, the fund is supposed to acquire actual silver to back those shares. The authorized participants who create new ETF shares have to deposit physical silver into the trust. So increased demand for ETF shares ultimately translates into increased demand for physical silver. But here is the nuance. The ETF system works smoothly when physical supply is abundant. When supply gets tight, the system can experience stress. Premiums can emerge between the ETF share price and the underlying metal value. Authorized participants might have difficulty sourcing metal, and the paper price can diverge from physical reality. This is why I always emphasize watching the physical market signals: lease rates, COMEX inventories, regional premiums, backwardation. These tell you whether the paper market is accurately reflecting physical reality or whether stress is building. Right now, those signals suggest stress. Backwardation persists. Inventories are declining, lease rates are elevated, physical premiums in Asia are extreme. Jane Street buying 20 million shares in this environment is not just a bet on price. It is a bet that the paper market remains connected to physical reality, that they can convert those shares into value when they choose to exit, that the system continues to function. That is a significant assumption in a market showing signs of physical stress. Let me give you a scenario to think about. Suppose Jane Street is right about the direction of silver prices. Suppose silver rallies to $120 over the next year. In a normal market, they would simply sell their ETF shares and book the profit. Easy. But suppose physical stress intensifies, suppose there are delivery failures on COMEX, suppose the ETF cannot source enough physical silver to back all the shares in circulation, suppose a trust event occurs where confidence in paper claims collapses. In that scenario, Jane Street's paper shares might not capture the full value of physical silver. The people holding actual metal outside the system would benefit disproportionately. I am not predicting a systemic failure. I am pointing out that the choice between paper and physical exposure has implications beyond just price direction. It involves assumptions about the continued functioning of the financial system, and those assumptions are being tested more severely than at any point in recent memory. Now, let me bring this back to you because ultimately what matters is how you position yourself. If Jane Street, with all their data and models and sophistication, is making the largest silver ETF bet in history, what does that suggest you should be doing? At minimum, it suggests you should be paying attention. At maximum, it suggests you should be positioning for the scenario they are betting on. But here's the key. You have to do this in a way that matches your risk tolerance and time horizon. Jane Street can hold through a 20% drawdown without blinking. They have the capital and the conviction. Do you? If you are going to follow the smart money into silver, you need to be able to hold through volatility. You need to have a plan. You need to know your levels. You need to understand why you own what you own. The worst outcome is buying because Jane Street is buying, then selling when price drops 10% because you never had real conviction. That turns their good trade into your bad trade. Position sizing matters. Conviction matters. Patience matters. Let me ask you something else. What would Jane Street have to see to become bearish on silver? They would need to see the supply deficit resolve. They would need to see industrial demand collapse. They would need to see investment demand fade. They would need to see central banks stop accumulating gold. They would need to see the fiscal trajectory of major governments improve. They would need to see trust in fiat currencies restore. None of those things are happening. All of those things are moving in the opposite direction. This is why I keep emphasizing the structural nature of this bull market. It is not driven by technical patterns or speculative fever. It is driven by fundamental forces that are not reversing anytime soon. The industrial demand from clean energy and technology continues to grow. The investment demand from monetary uncertainty continues to build. The supply from mining continues to lag. The deficit continues to compound. The inventory continues to drain. A 2% pullback on a Thursday does not change any of that. It is noise. It is the market doing what markets do, testing conviction, flushing leverage, creating opportunities for those who understand the bigger picture. Now, let me give you some specific things to watch over the coming days because these will tell us whether this pullback is a buying opportunity or the start of something more serious. First, watch the outcome of the US-Iran talks in Geneva. If talks break down, expect safe haven flows to accelerate. If talks progress, there might be brief profit taking before the structural trends reassert themselves. Second, watch the tariff implementation. If the 15% tariffs get signed, that is an escalation that supports precious metals. The market might initially sell the news, but the medium-term implications are bullish. Third, watch the dollar index. If it continues to weaken below 97, that is a tailwind for metals. If it reverses and strengthens back above 98, that creates short-term headwinds. Fourth, watch the ETF flows. If Jane Street's position is being followed by other institutions, we should see continued inflows into silver ETFs. Large sustained inflows confirm the smart money thesis. Fifth, watch the physical market signals. Lease rates, premiums, inventory levels. These tell you whether the stress is increasing or decreasing. If stress increases while price pulls back, that is a screaming buy signal. Let me close with something I want you to really internalize. The presence of Jane Street as the largest holder of the silver ETF is not a guarantee that silver goes up. Smart money is not always right. Models can be wrong. Unexpected events can change the picture. But when one of the most sophisticated trading operations in the world makes a record position in an asset, it tells you their analysis suggests opportunity. It tells you their models see something. It tells you the risk reward in their judgment favors being long. You do not have to follow them blindly, but you should take their positioning seriously. You should ask yourself what they might be seeing that you are not. You should consider whether the manipulation warnings being circulated are meant to protect you or to separate you from your position. The silver market is volatile. It always has been. It always will be. That volatility is the price of admission for the returns the metal has delivered over the long term. If you cannot handle the volatility, you should not be in the market. But if you can handle it, if you understand the fundamental picture, if you have positioned appropriately, then pullbacks are not something to fear. They are something to embrace. Jane Street is embracing this market. Mining companies are embracing this market. Central banks are embracing precious metals. Institutions are accumulating. The question is whether you will be on the right side of this trade or whether you will let fear and manipulation warnings shake you out at exactly the wrong moment. I know where I stand. I have shown you the data. I have walked you through the logic. Now you have to make your own decision. Drop a comment and tell me what you think about Jane Street's position. Do you trust the smart money? Do you think the manipulation warnings are legitimate? Do you think silver is going higher, or is this a trap? I want to hear your perspective because this community gets smarter when we share ideas and challenge each other's thinking. Also, tell me where you are watching from if you have not already. I want to see the global reach of this channel. Make sure you subscribe if you have not. Hit the notification bell so you do not miss the next update, because in markets like this, things can move fast and you want to be informed before the crowd. I will see you in the next video. Stay sharp, stay patient, and do not let anyone shake you out of a position you understand better than they do.